In 48 hours, silver did something markets are not supposed to do. It didn't drift. It didn't wobble. It snapped. On January 30th, 2026, after printing a peak near $121 an ounce earlier in the month, silver plunged roughly 27% in a single day, with lows reported around $64 before it clawed back toward the high 70s. It's the sound of leverage getting yanked out of a system so fast that price has no time to negotiate. They said this could never happen in a market as old and institutionally traded as silver. Most people only saw the chart. Institutions were watching the mechanics, because mechanics decide who survives a day like that. And here's the part that breaks the comfortable story people tell themselves afterward. When a real bottom forms, the market usually shows you relief in the plumbing. Spreads calm down, the panic premium fades, physical sellers appear, inventories swell. But this time, the story being sold was the bottom is in, while one detail kept flashing like a warning light. The paper price collapsed, yet the physical signal refused to confirm it. That mismatch is not a philosophy, it's measurable. In the same window that silver was collapsing, retail money poured into the biggest, easiest doorway it knows. iShares Silver Trust, ticker SLV. Over the 6 trading days ending February 6, 2026, about $430 million flowed into SLV, including more than $100 million on January 30th itself, the crash day. That is not cautious accumulation. That is a reflex, triggered by a drop so dramatic it feels like an invitation. Meanwhile, a major player on the other side of the world was positioned the other way. Zhongkai Futures, a Chinese firm, built a short position on Shanghai silver futures, equivalent to about 484 tons of metal, a position valued at more than $1.5 billion. Reporting described that position as delivering roughly $519 million in profit during the rout. Different audience, different information, different outcome. Welcome to Channel Name. This is where we decode what matters before it becomes a headline. And we do it with the data that tends to show up before the talking points do. If you come here for calm, mechanical analysis instead of emotional storytelling, you're in the right place. And as you listen, drop a quick comment with where you're watching from, because it helps me understand how widely these signals are landing. Now, let's reconstruct what actually happened and why the silver bottom narrative is missing the detail that matters most. The event wasn't just a price drop, it was a sequence. Silver ran hard, attracted momentum, and then hit a pocket of air where the market could not absorb selling at anything close to the prior price. When that happens, the reason is rarely a single headline. It's usually a chain. Volatility rises, risk limits tighten, margin pressures spread, and a rush to flatten positions cascades through the order book when funding math turns ugly. Start with the run-up. When a commodity moves rapidly, the market's composition changes. Participants who normally provide liquidity step back because volatility widens their risk. At the same time, fast money steps in because the trend is working. That combination looks powerful on the way up, but it's fragile. A market dominated by trend followers and leveraged exposure can move quickly, yet it can also reverse violently, because the same crowd that bought for momentum can sell for risk. Then comes the trigger. On a day like January 30th, it doesn't take a dramatic new fact to spark the turn. Sometimes it's simply the realization that the move has become too crowded. Sometimes it's a sharp intraday dip that hits stop levels. Sometimes it's a change in how collateral is priced, or in how much collateral is required. The key is that once selling begins, the structure matters more than the story. This is why exchanges and brokers are central characters, even if no one wants them in the plot. When prices swing, the system recalculates. If required margin rises, the effect is immediate. Leverage participants must post more collateral or reduce positions. If enough participants reduce positions at the same time, the market doesn't choose a lower price. It falls into it because bids vanish, and the decline itself can create the selling that drives the next leg down as losses force additional reductions. Now, here's the central mystery that should have been front and center. If the world had suddenly rejected silver, you would expect the physical market to breathe out. You'd expect vault inventories to surge as holders dump metal. You'd expect premiums to collapse as dealers compete to move product. Yet one of the most important physical snapshots in the world did not show a collapse. London Vault data showed that at the end of January 2026, LBMA London Vaults held 27,729 tons of silver, a small month-to-month dip of about 0.3%, not the kind of change you'd associate with a global mass liquidation. At the same time, an East versus West price gap showed up in plain sight. On February 6, 2026, one Shanghai price reference had silver around $81.55 per ounce, while the global benchmark was near $71.75, a difference of about $9.80. That's not a rounding error. That's a real premium, a sign that one part of the world was paying up even as the headline price was trying to convince everyone the metal was suddenly cheap and unwanted. Two realities, one metal. Those realities can diverge for a while, especially in a world of different contract rules, inventory location, shipping, financing, and regulatory friction. But they rarely diverge forever. Eventually, something forces convergence. Supply moves, credit terms change, or the paper market reprices toward the physical constraint. And a bottom is not a price level you can circle on a chart. A bottom is the completion of forced selling. And forced selling ends only when the participants who must sell are done selling, not when commentators feel tired of being scared. To see why that matters, you have to look backward because silver has done versions of this before. In 1980, silver experienced a historic spike and collapse as speculation, financing, and changing rules collided. The outcome wasn't just lower prices. It was a lesson that when volatility threatens the system, rules and collateral terms can shift, and those shifts can overpower whatever story traders were telling themselves the day before. In 2011, silver again surged, drew in late momentum, and then reversed sharply as conditions tightened and the trend broke. In both episodes, the dramatic top wasn't the end of the story. The aftermath was a redistribution, and the people who suffered most were the ones who believed a single word could summarize a complex clearing process. Now look at 2026 through that same lens. A sharp run, a violent break. Retail buying the dip in a highly liquid vehicle, institutions positioned to benefit from the collapse, and a physical signal that doesn't neatly match the paper narrative. When the same playbook shows up across decades, you don't need a conspiracy to explain it. You need incentives, and you need to respect the system's self-preservation instincts. Exchanges, clearinghouses, and brokers want stability. They don't care about the romance of a bull run. They care about the probability of defaults. Leverage traders want returns, and leverage works until it doesn't. Large institutions want liquidity and optionality. Dislocations create both. When volatility surges, the system protects itself by demanding more collateral and pressuring positions that cannot meet new requirements. That's not personal, that's structural. Think of it like a crowded theater with a narrow exit. When everything is calm, people can move around, but if panic hits, the exit doesn't get wider. The rush gets faster. Those closest to the door get out first. Those in the middle get pushed. Those at the back feel the pressure last, and they often pay the highest price for the chaos. In markets, the door is collateral. When margin rises or funding tightens, positions have to move through that exit. If you have collateral, you can wait. If you don't, you're forced to sell into whatever price exists in that moment. So who moved first in the sequence, and what does their behavior tell us? On the retail side, the evidence is clear. Money went into SLV aggressively right as the drop occurred. About $430 million over 6 trading days ending February 6th, and more than $100 million on January 30th. That timing matters because it reveals a belief system. It says a large crowd interpreted the crash as opportunity, not as a liquidation event still in progress. On the institutional side, the evidence points to positioning that benefits from a crash. Zhongkai futures short position equivalent to about 484 tons, valued above $1.5 billion, is not a casual trade. And the reporting of roughly $519 million in profit is not a lucky scratch ticket. It's the kind of outcome that comes from size, structure, and being positioned for forced flow rather than for a comforting narrative. Then there's the ETF layer, which sits between paper and physical like a hinge. If SLV holdings are around 16,247.45 tons as of February 5th, 2026, that's an enormous pool of metal represented by shares inside the financial system. It is liquid. Flows can surge into it or out of it quickly. It can also become a pressure point because it concentrates exposure. If sentiment flips and redemptions accelerate, authorized participants can source or deliver metal differently, and that can interact with futures hedging in ways that amplify the headline price move. Again, that's not a moral statement, it's plumbing. Now, let's go directly to the one detail that turns the bottom narrative into a question you can test. When the price collapses in the paper market, but physical inventories remain broadly steady and regional physical pricing shows a strong premium, it suggests the crash is not purely about a sudden lack of end demand. It suggests the crash is about forced selling in the financial layer. The first layer to break is usually the most leveraged and the most mark-to-market sensitive, not the slow-moving physical base. Paper silver trades in enormous volume relative to the amount of metal that changes hands physically. Futures and options allow exposure to be bought and sold with low friction. ETF shares allow investors to express a view without handling bars. That structure is useful. It provides price discovery and liquidity, but it also means the headline price can move dramatically when leverage unwinds, even if the underlying physical market is not suddenly awash in metal. Here's where it gets interesting. If one Shanghai reference can print around 81.55, while the global benchmark is around 71.75, that implies either demand in that region is stronger, supply is constrained, or both, relative to the price being printed elsewhere. Meanwhile, the global benchmark is reflecting the liquidation dynamics of a broader financial system clearing risk. Two different microclimates, one headline number. Why can't that persist? Because arbitrage exists in principle, even if it's not always clean in practice. If one region pays materially more, the incentive is to move metal there. But moving metal requires inventory, financing, and time. It is not the same as clicking a button. And when financing tightens, the cost of carrying inventory rises, which can actually worsen the short-term shortage in the high premium region. The very conditions that create a crash can also make physical tightness harder to relieve. So the bottom story assumes the panic is over because the price bounced. But the detail that matters is whether forced sellers are done and whether the physical signal has normalized. A bounce can happen because selling pauses. It can happen because liquidity returns for a day. It can happen because someone covers a short or because volatility traders rebalance. None of those automatically mean the process is complete. Let's make the mechanism simple without dumbing it down. Imagine a spring compressed by a heavy weight. The spring is the market's pricing mechanism. The weight is leverage and short-term financing. When prices rise, leverage increases because traders borrow against paper profits, brokers extend credit, and volatility looks tame enough to justify it. Then a shock hits. Volatility spikes. Risk managers react by raising required collateral or reducing exposure limits. That instantly increases the weight pressing on the spring in the wrong direction. To meet new requirements, some traders sell. Selling pushes price down. The down move increases losses. Losses trigger more selling, either voluntarily or through forced liquidation. That additional selling pushes price down again. Each cycle feeds the next. This is why a market can print $64 after recently printing $121. It's not a statement about geology, it's a statement about credit. Now, layer on the second mechanism, narrative timing. When the drop happens, a familiar script appears. Retail money tends to arrive after the move because it's responding to the story, not to the margin call schedule. That's why the SLV flows matter. They are a visible trace of who acted when the system was still absorbing shock. Institutions that operate with mandates, models, and access to funding treat the same event differently. They look for dislocations. They look for forced flows. They look for moments when price detaches from the slow-moving physical reality and from the slower-moving industrial and investment demand that doesn't flip overnight. That brings us back to the dislocation, because a dislocation is the fingerprint of forced behavior. If London Vault inventory is basically steady at 27,729 tons at end January, and if a Shanghai reference can sit nearly $10 above a global benchmark on February 6th, then the bottom cannot be judged purely by the chart. The market is telling you different layers are clearing at different prices. The paper layer is clearing leverage. The physical layer is reflecting constraints and frictions. One more layer makes this even clearer. The way paper volume can dwarf the feel of the real market. A futures contract can change hands many times in a day without a single bar moving. That is not a flaw. It's how financial markets express risk. But it means the headline price can be driven by who is forced to transact, not by who truly wants or doesn't want the metal for industrial use, for reserves, or for long-term holding. When liquidation hits, it hits the most leveraged layer first because that layer has the strictest time limit. That is why the words people use right after a crash are often misleading. Capitulation sounds final, but a system can have multiple waves of it. The first wave is the obvious one, when price gaps and stop orders cascade. The second wave can be quieter, when risk committees reduce limits, when funds cut exposure to meet volatility targets, and when hedges are rebalanced mechanically. The third wave can arrive later when enthusiasm returns too quickly, and the market tests whether the new buyers can actually absorb supply without leverage. And this is where the silver bottom story becomes a trap. If a rebound is powered mostly by relief and positioning adjustments, it can fade the moment new selling meets thin liquidity. If a rebound is powered by genuine physical tightness, it tends to show up in narrowing spreads, steadier pricing, and easing premiums. The point is not to guess which one it is. The point is that the market gives clues, and in early February 2026, the clues were still mixed. So the one detail to keep returning to is the relationship between the screen price and the cost to source real metal where it is demanded. When those two line up, the market is balanced. When the screen price breaks while physical stays firm, the move is telling you more about credit, collateral, and forced flow than about silver itself. That mismatch can resolve violently in either direction, without warning for anyone watching. So what does that imply going forward, without turning it into prediction theater? Historically, when you see a leverage-driven crash paired with a physical signal that doesn't collapse, you tend to see one of three broad paths. In the conservative path, The paper market stabilizes, volatility declines, and regional premiums narrow because logistics and inventory gradually catch up. Prices may chop sideways while the system rebuilds confidence, and while participants who were burned reduce position sizes. In the moderate path, the paper market rebounds as short covering and renewed risk appetite lift price, while the physical premium remains elevated longer than expected, implying ongoing tightness or persistent frictions that pressure the financial layer. In the aggressive path, the physical constraint forces repricing. Paper price moves higher to reflect the difficulty of sourcing metal in the tight regions, even if the memory of the crash keeps participants cautious. Notice what's missing from those paths. There's no guaranteed target. There's no single number prophecy. There's only a set of conditions that historically lead to certain types of outcomes. The market doesn't owe anyone a clean V-shape just because the word bottom feels emotionally satisfying. So what should be watched is not a social media consensus. It's indicators. Watch whether regional premiums persist or fade, because a persistent premium is a sign the physical layer is still tight. Watch whether vault inventories trend meaningfully up or down, not by a few tenths of a percent, but by repeated, directional changes that suggest flows. Watch whether large vehicles like SLV continue to attract inflows or begin to see redemptions, because those flows can amplify or dampen volatility in the financial layer. Watch whether volatility compresses or remains elevated, because volatility is the language of margin. And watch the calendar around risk events. Large moves often cluster near moments when collateral is reassessed, month-end balance sheet considerations, sudden volatility spikes, or policy adjustments that change risk weights. You don't need to know the exact memo. You just need to recognize the pattern that a system under stress tightens conditions, and tightening conditions can create price air pockets. Most of all, watch the gap between what the price says and what the physical market does. When those two agree, narratives tend to be honest. When they diverge, narratives become marketing. This is where the divide forms. There are people who treat markets like stories. They want a clean arc, up, down, bottom, recovery. They want a single word that ends uncertainty. Bottom is that word. It feels decisive. It feels safe. It feels like control. Then there are people who treat markets like systems. They understand that the first rebound after a crash can be a pause, not a resolution. They understand that what matters is not the loudest claim, but the quiet constraint. They track flows, inventories, premiums, and the conditions that force behavior. They know institutions tend to move when the mechanism changes, while the crowd moves when the headline changes. It's not about being smarter. It's about being disciplined enough to look at the unglamorous data. The information gap becomes a wealth gap because institutions move early, when the plumbing shifts and retail tends to move late, when a narrative becomes popular enough to feel true. So when someone says silver found its bottom, ask the one question that cuts through it. Did the physical market confirm it? If inventories are steady, if regional premiums remain wide, and if the crash was driven by forced selling in the financial layer, then bottom is not a fact. It's a belief. And beliefs can be expensive when the system hasn't finished clearing. This is channel name, where we decode what matters before it becomes the headline. If this connected dots you hadn't lined up yet, you know what to do. And remember, the question isn't whether markets move. The question is whether you can see the mechanism before the narrative tells you it already happened.